Hello and welcome to People Making Money. I'm your host, Kevin Bemmel, and we are here every Wednesday at 10 a.m. Pacific time to talk about matters relating to business and professional success, as well as wealth building. And one of those issues that impacts both sides of that equation is taxes, right? They say nothing in this world is sure except death and taxes, and we're making a lot of progress on the death side of things, but taxes are inevitable. And so back in, I believe it was July 24th, I did a show called basically Taxes Effect on You and the Economy. And I realized toward the end of that I had only done part of the subject. So that was part one. And this is part two of this subject. So um, in part one, I talked about income taxes, property taxes, all right, payroll taxes and property taxes, those kind of things. So today, I'm going to be talking about capital gains taxes and kind of mixed with that a little bit of estate taxes. They're not the same thing, but and I talk about estate taxes much more thoroughly on my Monday show, Trusts and Estates Weekly, but I am going to touch on them as part of capital gains taxes so you can understand how those two work together. So that is excise taxes and tariffs. Now, you may be saying tariffs, wow, that's a big political issue right now. Yes, tariffs are a big political issue. I'm going to be talking about them from the standpoint of how they work and the impact they have on us as consumers, us as employees, and the impact they have on the economy, rather than opining any particular political position on tariffs. Although most people would probably divine where I'm coming from on that. I'm not making it a secret. I won't make it a secret, but I'm not going to get into a political polemic on it. So let's start with capital gains taxes. Let's first of all, what are capital gains taxes? So, as the name states, they are taxes on the gains from some kind of capital investment. Okay, so let's say, for example, that you buy some stock. Let's say you buy $1,000 worth of I don't know, AT&T. Okay, and you hold that stock for 6 months, and you sell it, for $1,100. Okay, and for the purposes of this discussion, I'm going to leave off the issue of brokerage fees. These days, depending on what platform you're using, they may be little or even zero in some cases. Okay, so you bought it for $100. I'm sorry, you bought it for $1,000. That's what's called your basis or your cost basis in that investment. Okay, so you bought it for $1,000. You sold it for $1,100. So you had a gain of $100. $1,100 minus your original acquisition cost of $1,000 equals $100. Now you say, well, gain, isn't that profit? Yes, it's profit. From a tax perspective, it's called gain. Now, because you receive that gain within a year of when you made the investment, when you bought the stock, it's what's called a short-term capital gain. Okay, that's a short-term capital gain is a gain on an investment that you recognize, meaning you've sold the investment and actually received the gain. Okay, it's in your checking account, for want of a better way of putting it. Okay, so if it's a year or less, it's a short-term capital gain, and it's taxed just like your ordinary income. Okay, now, by the way, on a stock, you may also get paid dividends. Those dividends, generally speaking, are not capital gains. Those dividends are a form of investment income, okay, and they're taxed like, generally speaking, as ordinary income. really no matter when you get them, okay? But the increase in value of that stock is in this case, a capital gain, okay? And it's $100, but since it's a short-term capital gain, i.e. it was recognized a year or less after you acquired the investment, it's taxed as ordinary income, just like your salary and everything else. Okay, let's take a slightly different example. Let's take a case where you bought you bought some stock for $1,000. Okay. 6 months later, you sold it for $900. In other words, you sold it for less than your basis in the stock. So you had a loss, okay, not a gain. Okay. So you had what's called a capital loss. Do you pay taxes? No, because you had no profit, you had no gain. Now, what happens with that $100 loss, right? You bought it for $1,000, sold it for $900, you lost $100. What happens? Well, that capital loss may be deductible against your other income. Okay, so you have a short-term capital loss of $100, you might be able to deduct that from your salary or other sources of income. Now, you're going to hear me say might a lot, because all of these things depend on your particular tax situation. So I'm not an accountant, I'm not a tax preparer, not giving you specific advice for your situation. I'm giving you concepts so you can understand how these things may work. For your specific situation, you'll need to have your tax preparer or your accountant look at the situation and let you know, okay, well, here's how this is going to play out. Okay, so a year or less, a gain is a short-term capital gain. A loss is a short-term capital loss, basically treated like ordinary income, okay, it's salary and such. Now, let's say you hold the investment for at least a year plus a day. Okay, so now in this scenario, you bought $1,000 worth of stock, and let's say 18 months later, you sold the stock and you got $1,100. So again, you have a $100 gain, but now you've held the investment for 18 months, i.e. at least a year and a day. So you have what's called a long-term capital gain. And long-term capital gains are, hang on one second. I meant to look up the rate, so I knew it. Yeah, so long-term capital gains are taxed at a lower rate than ordinary income, or what may be a lower rate than ordinary income, okay? Because the first part of a capital gain is taxed at, up to about $45,000 of capital gain, at least as of the rates last year, there's zero tax. Okay, from about $45,000 to just under $500,000, the rate is 15%, and then over that it's 20%. Now, keep in mind, for someone who makes $500,000, they're going to be in the top ordinary income rate, almost for sure, right? So the capital gains rate at 15 or 20% is going to be lower than that top marginal rate on ordinary income. Okay, now, why does the government offer a lower capital gains rate? It's to encourage people to invest, okay, to take the risk of investing in the stock market. Or capital gains applies really to any investment. It applies to real estate. You could invest in collectibles, in artwork, in cars. Anything that you can invest in, oil and gas leases, cryptocurrencies, I think those also qualify for capital gains. Okay, so any of these investments, okay, the government, the tax code is used to encourage us to invest in them, because when we make those investments, we help the economy grow. Okay, we provide capital for businesses to start up, to expand, to enter new markets, to do research and development. All of the things that make our economy grow come from capital investment. Okay, so now let's look at the reverse situation. Okay, let's say you buy an investment for $1,000 and 18 months later you sell it for $900. Now you have a long-term capital loss. Okay, you may be able to, so if you have other capital gain, long-term capital gains, you can use it to offset those long-term capital gains. You may be able to use it to offset your ordinary income. Again, that'll depend on your specific situation. There are a lot of rules, and it gets complex pretty quickly, right? So I'm giving you just the basic information about how capital gains taxes work. Okay, so again, a year plus a day or longer you hold an investment, you have a long-term capital gain or a long-term capital loss. Now, why would you take, for example, a long-term capital loss? Well, let's say you own several stocks, one of which has had a huge gain, okay? But you're looking at it and you're thinking it's topped out, it's time to sell it, because you're afraid that its growth is going to stop, and it may even decline in value. Okay, and on the other hand, you've got another stock that you've taken a big loss in. Okay, and you know, maybe you think it's not really going to increase in value in the short term. So you can sell the one stock and take the big and recognize the big capital gain. You can sell the other stock and recognize the capital loss and offset the two and reduce or eliminate the capital gains tax on that transaction. Okay, now here's the thing. What some people think they can do is they sell the stock with the big gain, right? They lock in their gain, good, right? They sell the stock that's lost a lot of value. They lock in their loss, right? They offset them and pays, little or no taxes, right? And then they turn around a few days later and they buy back the stock that they sold at a loss. Okay. Now, you can do that, but if you do that too quickly, the IRS will treat that stock as if you never sold it, and they will disallow, or they may disallow, the long-term or the capital loss that you're taking. And now all of a sudden you've got this big gain with nothing to shelter it, and so now you owe a big capital gains tax bill. Okay, so if you're going to use that strategy, okay, just recognize that when you sell a stock, there's a certain amount of time period, there's a certain time period you have to wait before you can repurchase it. And it's not just the stock, by the way. It's also repurchase if you were to purchase options to acquire the stock and other things like that. So there are other instruments that would count as, in essence, repurchasing the stock. Okay, so again, these strategies can be a little bit complex, and you want to make sure you understand the rules before you work them on your own. Okay, otherwise, make sure you have a competent financial advisor who can help you understand these rules and make sure that you don't do something where your great tax saving strategy falls apart because you reacquired the stock sold at a loss too quickly, and now the IRS disallows that loss, and now you have they're not going to let you turn around and say, oh, I didn't mean to sell the stock at a gain. Then no, they're going to say we want our taxes, and that's that. Okay, so that's capital gains. Now, as I mentioned before, there are on pretty much any kind of capital investment you make, capital gains taxation will apply. Now, let's take real estate as an example. let's say that you bought a property for an investment. This is not your house. Okay. This is not your house. Let's say you bought an apartment building, and let's say you bought it 20 years ago and you paid $1 million for it. And you're looking at it today and you see you've had great rent growth. You've had, so the building is worth, let's say now, not the building, but the property today, after 20 years is worth, let's say $3 million. Okay. And you realize that if you sell by the way, you bought it for $1 million. Okay. Now, because it's an improved property, meaning there's a building on it, it qualifies for depreciation from a tax standpoint. Okay. I talk about this in my show on investment real estate. So the tax code allows us to depreciate the building, the portion of the property that's building. Okay. So let's say out of the $1 million that we spent for that property, let's say $600,000 accounts for the building and $400,000 accounts for the land. Okay, so the $600,000 portion can be depreciated. It's, I believe, if it's a residential income property, I think it's like 31 and a half years or something like that. So what that means is you can take a deduction on your tax return of depreciation of approximately $20,000 a year. Now, you haven't actually spent $20,000. It's a deduction you get because, at least in theory, the building is wearing out. That's what depreciation is. Okay, but let's say now it's, what did I say? It's 20 years later. If you've taken $20,000 a year in depreciation on that building, 20,000 times 20 is $400,000 in depreciation expenses that you've taken over the past 20 years. So the property, when you bought it at $1 million, had a cost basis of $1 million. 20 years later, the cost basis of $1 million has to be lowered by the depreciation that you've expensed on your taxes of $400,000. So what's called your adjusted cash cost basis is now $600,000. Okay, do you see that? You paid $1 million originally. You've taken a total of $400,000 in depreciation expenses over the past 20 years. $1 million minus $400,000 is $600,000. Okay. Now, why can you only take it on the building? Because land doesn't depreciate, just as a concept. Okay. So, of the $600,000 adjusted cost basis that is left 20 years later, $400,000 of that is land. $200,000 of that is building. Okay. And now today, you can sell it for $3 million. So, and again, I'm not going to take into account brokerage fees and closing costs and all of that to keep things simple. So you sell the building for $3 million. Okay. Now, you'll notice that your profit is $2 million because you originally paid $1 million for it. You sold it for $3 million, so your profit is $2 million. Okay, here's where it can get a little tricky. Your gain is what you sold the property for minus your adjusted cost basis. So your gain on the property, the gain that you recognize when you sell the property, is $3 million minus $600,000. Sorry, $3 million minus $600,000, or $2,400,000. That's your gain. Do you see that your gain is $400,000 higher than your profit? Why? Because the tax code let you take that $400,000 in depreciation deductions. Okay. Now, here's what's neat about it. When you took those depreciation deductions each year, you were reducing income from operating the building that is taxable at ordinary income rates. Now, when you sell it and basically you recognize the gain that equates to the depreciation deduction, so the $2 million profit plus the $400,000 of sort of the, recognizing the depreciation deductions. So the $2.4 million, assuming you've owned that building for at least a year and a day, and therefore it's a long-term capital gain, that 400,000 deduction that's now being taxed is only taxed at the capital gains rate. So if your ordinary income rate was 28%, okay, by taking that those $20,000 per year deductions, you saved the equivalent of 28% of $20,000 each year, or about $1,400. So you saved $1,400 times 20. Wait, I'm going to make sure I have my math right because I'm doing it in my head. So 20,000 times 28%. Sorry, not $1,400. It's 20,000. It's $560. So you saved $560 in taxes per year, okay, times 20, okay, so you saved $560 times 20 is, I think, $112,000 in taxes over the 20-year period. Now, when you sell the property and pay long-term capital gains taxes, okay, that $400,000 is taxed at only 20%, or $80,000. So you saved $112,000 initially. You end up having to pay $80,000 in capital gains taxes, long-term capital gains taxes on those depreciation deductions. So overall, you've avoided $32,000 in taxation. That's one of the benefits of buying real estate. Okay, is it produces income that is sheltered by the depreciation deductions, that then when the government comes back and basically taxes those previous sheltered funds, they're taxed at a lower rate. Okay, so on $2.4 million worth of gain, you're going to be paying, roughly $470,000 in taxes, something like that. Okay. Now you're saying, wow, but that's still a lot of taxes, right? Almost $500,000 in taxes. I'm losing, a quarter of my profit. Well, that's true, right? So one of the things you can do to avoid long-term capital gain taxation with real estate is you can do something called a 1031 exchange. What's oftentimes called a tax-free exchange, but that's not a correct way of describing it. It's actually a tax-deferred exchange, okay? And the reason is because if you do a 1031 exchange, it's not that you get out of paying taxes on that sale. It's just you defer the date. You put off the date when that gain is taxable. Okay, so I'm not going to go into the mechanics of a 1031 exchange. Maybe I'll do another show on that. But let's say that you sell the property for $3 million and you take the $2 million in profit that you got selling the property, and you turn around and use that to buy a $4 million property. Okay. Now, if you just bought a $4 million property from the get-go, okay, your cost basis would be $4 million. But since you're exchanging a previous property for a new property, okay, Your cost basis in the new property is going to be your original adjusted cost basis, which you recall is $600,000, plus, in essence, the difference between the selling price of that building and the purchase price of the new building. Okay, so your cost basis when you buy that $4 million building is going to be $1.6 million. Now, again, there's adjustments. I'm just using real simple figures. It wouldn't actually work out quite that way, but keeping the example simple. Notice your basis in the new property that you bought for $4 million is $1.6 million. If you turn around the next day and sell it for $4 million, what's your gain? $2.4 million, which was the gain in the building that you sold to exchange for the new building. So do you see how the capital gains taxes are deferred? They're not avoided. Okay. Now, why does the tax code allow us to? By the way, it's called a 1031 exchange because the provisions for it are in section 1031 of the Internal Revenue Code. That's where the name comes from. Now, why does the tax code and why does Congress allow 1031 exchanges? Well, the idea is to encourage people to reinvest their money and not sell a property and spend the money. Okay, so as I was saying before, one of the impacts of capital gains taxation on the economy at large is it encourages investment in whether it's real estate, businesses, collectibles, stocks, bonds, whatever it is. It encourages investments, and those investments help our economy grow. They help the number of jobs grow. All of this is good for the economy, right? The term capitalism comes from the idea that people take money, capital, and invest it in some kind of venture with the hope of making a profit, okay, and at the same time helping the economy grow. Okay, that's fundamentally what capitalism is all about. Okay, so when capital gains rates increase, what that does is it tends to stop people from selling investments. Okay, so they leave their money in whatever investment it is in because they don't want to pay the higher capital gains taxes. Now you can say, well, so what? No big deal. Well, maybe no big deal, but there may be a more productive use for that capital. So if the tax code, the higher capital gains tax rate, keeps the money locked into one investment where it would be more profitably used somewhere else, what we're doing is we're reducing the ability of the economy to grow. We're reducing the ability of the economy to add jobs. Okay, so this is why historically the capital gains rate has been lower than the ordinary income rate. It's to encourage people to invest, but also to sell their investments and move the capital to more productive. Now, in this case, more productive is determined in financial terms. It means more profitable investments. Okay. And if an investment is more profitable, generating more income, okay, that's good for the economy. I know in some circles it seems like profit is a dirty word, but from our perspective, would we rather have an investment that generates a 5% return or a 10% return? Okay, well, assuming that we're willing to take the additional risk, we'd like to make 10% on our investment, right? And if we're willing to take that risk, we don't want to leave our investment in a 5% return investment. We want to move it to the higher return. Okay, so what happens oftentimes is when the capital gains rate goes up, people they not only don't sell their investments because they don't want to pay the higher taxes, but they also don't sell them because they start thinking, well, I'll wait for the rates to come back down before I sell them. So capital gets, in essence, frozen. It's less mobile, and that is not good for the economy, because people who want to start new ventures, new companies that can increase employment, it's harder for them to find investment capital to do that. Now, you may be saying to yourself, well, wait a minute, there's like trillions of dollars available in private equity funds and in the stock market. All yes, that's true, but those funds, not only a fraction of them are available for investment. Once those funds are invested, are people going to put more, are people going to save more money in order to make more investments? If the capital gains rates are high, they won't necessarily do that, because the after-tax return on those investments is decreased by the higher capital gains tax rate, and therefore it's not as profitable to invest. It's not as interesting to invest. So maybe I'll just take a trip to Europe or Australia or China, or well, maybe not China, but Japan, and I'll do that instead, since I'm not going to be able to get a great return for the risk that I have to take anyway. So I might as well just spend the money, consume the money, in other words. Okay. So this is how capital gains taxes affect not just us, but the economy in general. And this is why they exist. They're there, one last time, to incentivize us to invest in businesses and other types of investments that will help the economy grow, help with job growth, all of that, and keep capital moving into ever more productive, i.e. profitable investments. Okay, so that's capital gains taxes. And by the way, they're not charged just at the federal level. Many states also charge capital gains. Now, here in California, there isn't a special capital gains rate. Capital gains are taxed just like ordinary income, whether they're short or long term. Okay, which makes California, it's one of the things that makes California a very high tax state. Okay, other states have separate capital gains rates. So depending, and generally speaking, you'll pay the tax rate based on where the investment is, not necessarily where you are. So if you live in Florida, which has no income tax, but you own a building here in California, you're going to pay California capital gains taxes on this building, right? I was having this conversation with a client the other day, and she was like, wow, I'm not sure it makes sense to own a building in California. Well, see, there you go. This is one of the challenges of being in California, is people are recognizing more and more the very, very high taxes we pay in California discourage people from investing here. They would rather invest in Florida or Texas or Arizona, in a state that has lower taxation, so they get a better after-tax return. And so the competition among states for capital investment, the capital gains rates that the states charge have an impact on where people will invest their capital, right? So that's why you see so much capital investment going on in states like Florida and Texas that have no income tax, no state income tax, okay, because the after-tax return on these capital investments is higher than they are in a state like California. Okay, so that's capital gains taxes. Next on the hit parade are excise taxes. Now, you may have heard the term, but you may be thinking to yourself, I've never filed an excise tax return. You probably never have. Okay. That's because excise taxes they're kind of like sales taxes, in the sense that when they're typically added to the price of something that we buy. So back in July, when I did my part one of this, I think I also talked about sales taxes, as I recall, right? So a sales tax it's typically a municipal tax, okay? And let's say you buy something for $100 and the sales tax is 8%. So when you pay for the item, you're going to pay $108, okay? And the $8 is going to be sent to the state by the merchant when they remit their sales tax receipts each month or quarter, whatever the reporting period required. So excise taxes are work in a similar way. It's that they're not a sales tax. Generally speaking, excise taxes are levied to direct consumer behavior. So, for example, most states and the federal government too have an excise tax on gasoline. They call it a gas tax. It is a type of excise tax. Okay. And the reality is, when you go to the pumps here in Los Angeles, I was the other day, I think gas was like $4.49 a gallon. Of that, I think around $1 or $1.50 are actually various excise taxes. Okay. So a quarter or a third of the price of a gallon of gas are excise taxes. Now, why does the government charge an excise tax on gasoline? Well, they do it for several reasons. One is because they in theory, at least here in California, for example, they use the money they collect to repair roads. So people who are buying gasoline are using roads. They're creating wear and tear on those roads, and so they should pay for them. And the more gasoline you buy, the more you drive, presumably, so the more wear and tear you put on the roads, and so therefore the more excise tax you pay to repair the road. So it makes sense, for sure. It makes sense. Okay. However, here in California, one of the reasons why our gasoline taxes are so high is to make gasoline expensive so that we don't buy as much of it. So you may have heard the phrase or sin tax. So excise taxes are oftentimes they're often used in order to impose sin taxes. So here in California, and I think this is true of almost all the states, if not all of them, there's also an excise tax on cigarettes. So the price of a pack of cigarettes today, I think, is like $5-6 a pack or so. I mean, I'm not a smoker, so I don't know. All I know is the price of a pack of cigarettes has gone up by a tremendous amount. It's not because the cigarette companies are charging more. It's because the amount of excise taxes keeps getting raised. And one of the reasons, again, there's generally speaking two justifications for doing it. One is to pay for programs to treat smokers who get disease from smoking cigarettes. The other is to make it expensive so that people will buy less cigarettes, right? They will commit less of a sin, right? That's where the name comes from, sin taxes, right? So here's the thing about excise taxes, and in particular, sin taxes. Generally speaking, because they're an ad valorem tax, meaning they're charged as a percent of the price of the item, they're what's called a regressive tax, meaning lower income people are hit by it harder than higher income people, okay? Because a larger share of their income goes to pay for gasoline, for example. So it makes it more costly for them to have transportation, okay? Because everybody pays the same amount. Like I said, here in Los Angeles, about, I think, $4.50 a gallon. So if someone's making $1 million a year, paying $4.50 a gallon for a gallon of gas is no big deal. But if you're making $40,000 a year, Okay, $4.50 a gallon for gas is a lot of money. It's a lot larger percentage of your income. Okay, and so that's what it means when we say a tax is regressive. Sales taxes, as you may recall from part one of this series, is also a regressive tax. Okay, so now you may say, well, that is the way it is. Yes, it is, and that's why what's one of the reasons why, for example, especially here in LA, for you see lower income people using public transportation, because the cost to own a car, including paying for gasoline, is more than they can afford. And so the gasoline tax also in essence forces people to use public transportation. But there is a cost to using public transportation, and that is it takes you a lot longer to get somewhere by bus than it does by car. Okay, especially in a city like Los Angeles that's so big. And I think the most frequent bus service is like every 15 minutes. Okay. And a lot of times these buses are packed. If you can't get on a particular bus, now you're going to have to wait another 15 or maybe it's 10 minutes. But and they don't necessarily, they don't go in a straight path to where you want to go. So you have to go the paths that the bus goes. So what also happens for lower income people who are forced to take public transportation is that in essence, they pay a price in loss of productivity, okay, because they have to spend more of their time getting from point A to point B. That may mean they're spending less time with their family. It may mean they can't work as long hours because they've got to be home in time to, greet their children from school or whatever it is. Okay. So one way or another, people, pay for an excise tax on something like gasoline. Now, when we look at cigarettes, you might say, well, poor people shouldn't be smoking cigarettes. Well, the fact of the matter is it's unhealthy for anybody to smoke cigarettes. Interestingly enough, it is the majority of smokers, at least cigarette smokers, are lower income people. And so because they're so addictive, they end up continuing to smoke even as the price of cigarettes rise. They might not smoke as much, but again, the excise tax on cigarettes is a regressive tax. It hits lower income people harder, okay? And again, the idea is it will discourage them from smoking, and it does. I'm sure it works for some people, but for other people for whom the addiction is so strong, what it does is it means they have a lot, less money available to buy other things. Now, another type of excise tax, or another category, we'll call it, not type, another category of excise tax, it's called a luxury tax. So I don't know if there is still a tax on so-called yachts, like large boats, right? But from time to time, the federal government may levy an excise tax on yachts. It's added into the price of the yacht, okay? So it just like the sales tax. And the idea is someone who can afford to buy a great big fancy boat should pay higher taxes. Okay, so in this case, where the tax is not regressive, it's progressive, meaning the more you make, the more more taxes you pay. It's not exactly progressive the way the income tax is, but because generally speaking, only very wealthy people buy yachts or airplanes, which is sometimes, I'm not sure if right now there's an excise tax or a luxury tax on airplanes, but because it's very wealthy people who tend to own these, so it's an additional tax that they pay because they're wealthy enough to own these luxury items. Okay, so excise taxes are levied by the government in order to achieve certain goals. One is to derive tax revenue from a source that will benefit from how the tax revenue is being used. We see that with the gasoline tax. At least part of the gasoline tax is allocated to repair roads or build highways, that sort of thing, which, then the people who are paying for the gasoline benefit from because they drive on them. They're levied in order to discourage people buying things. Okay, for example, the cigarette tax, that's an excise tax that's levied in order to discourage people from buying cigarettes. Okay, and then they're levied on people who are wealthy, who buy these luxury items, because if they're going to buy this luxury item, we're going to, the taxing authority is going to take some additional taxes from them because they are so wealthy. Now, here's the thing about excise taxes. They can have some perverse consequences. So, for example, when there was an excise tax on yachts, what happened was the number of yachts bought by people declined precipitously. And a lot of yacht brokers, these are people who sell these large boats, went out of business. As well, people who worked on these boats didn't get as much business because people, they didn't want to own them, so they weren't being built. And so there wasn't as much maintenance business. There wasn't as much storage business. There wasn't as much business for making items that yachts need, like sail covers, sails, compasses, all these kind of things that yachts have. There wasn't as much fuel sold for a motor yacht. Okay, so luxury taxes can also negatively impact the economy by reducing the opportunity for businesses related to the particular type of item on which the luxury tax is being levied. And my recollection is the yacht tax was repealed a while back, and one of the reasons was because so many yacht brokers were essentially going broke, no pun intended. People just were not buying yachts, and yacht manufacturers too they were going broke because nobody wanted to buy these expensive boats and pay such a high tax. I mean, we're not talking a sales tax level of 5%. We're talking about, I think at the time it was, I want to say 30%. I may be wrong on that percentage, but it was a large. So if you're buying, a $10 million yacht, and on top of that you have to pay a 30% excise tax, $3 million. Now it's going to cost you $13 million to buy something that really you're looking at and saying, but it's only worth $10 million. So do I want to buy that? And the answer is likely to be no. I'm not going to buy that. Okay. Again, same with aircraft, other these luxury items. So while it's tempting to say, well, but they're rich, they can afford it, that may be true. But the question is not just can they afford it, it's will they pay it? And if the answer is no, then a lot of other people who aren't fabulously wealthy and can afford a yacht may be hurt by that luxury tax, because now their business is not going to it's not going to prosper. In fact, it's going to deteriorate and potentially close because there's not enough work to go around. Okay, and so now they lose their source of income, and now what do they do? Okay, so the impact of luxury taxes on the economy, it tends to depress or lower economic activity because the people who have the money to, in this case, it's not really investing in a yacht necessarily, although many people do look at buying a yacht as an investment where they're hoping to be able to sell it for more than they bought it. But they're putting less of their money into buying a yacht, for example, and they may just put it in stocks or something else. Okay, so it changes who will be successful in our economy. Okay, so you may say, well, okay, so the boat builders will have to go do something else. Yes, they may. Of course, that can be difficult. And if you had a family yacht building business for the last 150 years, it can be gut-wrenching to have a high luxury tax put on yachts, and now you're put out of business, and your family business closes, and now what are you going to do? Because your whole life, you grew up in the business, something like that. So, and look, I'm not saying I'm not trying to create a sob story, but that is the reality of how these things work. Okay, so again, in general, luxury taxes. So sometimes you'll hear, well, the government is picking winners and losers. So the luxury tax is one of the ways that government does that, in essence, to decide, sort of which businesses are in essence disfavored. They would never describe it that way, but the reality is, if someone has to pay a 30% tax to buy what you're producing, essentially what the government is saying is, maybe you don't want to buy that, right? Because a lot of people are not going to want to pay, like I said, on a $10 million yacht, another $3 million to buy it. So that's the issue with excise taxes, okay? The people, and the fact of the matter is, the businesses don't pay the excise tax per se, because the cost of the excise tax is passed through to the consumer, right? So the oil companies don't pay excise taxes. The gasoline companies don't pay excise taxes. We do, because it's added into the price of a gallon of gas. And so they're just what are called intermediaries. They collect the tax, turn around, and give it to the government. Okay, so it's not, people say, well, gasoline taxes, these oil companies can afford it. They're not paying a penny of it. Okay, we pay excise taxes. We consumers pay excise taxes. Again, same with the luxury taxes. You say, well, wealthy people can afford it. That may very well be true, but it's not the boat builders that are paying the tax. It's the boat buyers that are paying the tax. But unfortunately, the people who are most negatively affected by it tend to be the boat builders and the boat brokers, because it reduces activity in that sector, and now they have less or no work, and they go out of business. Okay, so that's some of the ways that excise taxes impact our economy. Okay, finally, talk about tariffs. Now, again, tariffs are a lot in the news. Both presidential candidates are talking about tariffs. President Trump imposed tariffs. President Biden left them in place. So a tariff is essentially a tax that is paid on goods that are imported from another country. Okay, so you may have heard of things like steel tariffs, tariffs on wine, tariffs on cheese. Okay, oftentimes tariffs are levied in order to protect a domestic industry. So let's just talk about steel. Steel is a good example. So there we have a few steel companies here in the United States: U.S. Steel, Bethlehem Steel, etc. Okay, the cost to produce steel in the United States is higher than it is in other countries. For example, China. Okay, so what happens? So let's say that I'm a business and I need raw steel for my business. Maybe I'm an automobile manufacturer. Maybe I manufacture steel girders for building construction. Excuse me. I'm going to use the example of of buying steel to manufacture automobiles. Okay, so let's say I'm going to buy 1,000 tons of steel to manufacture automobiles. Okay, and let's say that 1,000 tons of steel, if I bought it here in the United States, would cost $1 million or $1,000 a ton. I don't know what the actual price is. It doesn't matter for this example. Okay, so if I buy it here domestically, let's say it costs me $1 million. Okay, 1,000 times 1,000. Okay, but let's say I could buy it in China for $500,000, and it'll cost me $100,000 to bring it here. It's still It's still the total cost of the Chinese steel, even with the transportation costs, are $600,000. In other words, it's 60% of the cost to buy domestic steel, steel made here in the United States, right? So what's going to happen? Well, if I'm smart, right, I'm going to go buy the steel in China for a number of reasons. I mean, primarily it's cheaper, but what does it mean to be able to buy steel less costly? Well, number one, it means I can sell my product for a lower price. Number two, it gives me more money to pay higher wages. Okay, so the fact that steel costs less for me to buy in China and transport to me would incentivize me to buy steel from a foreign steel producer. But what about the US steel producers? What's going to happen to them if I don't buy my steel from them? Well, they're going to lose business, right? So you say, well, they should cut their prices. Well, they may, but maybe they can't. Maybe the structural costs of their business are such that maybe they could sell the steel for $900,000. They're still at a $300,000 price disadvantage. So what's going to happen? The amount of domestic steel bought is going to shrink, and the domestic steel business is going to shrink. What's going to happen? Steel workers are going to be laid off. Okay, so the people who work manufacturing the steel, some of them are going to get laid off. In addition, other businesses that provide raw materials to steel manufacturers, such as iron ore miners, coal miners, well, probably not coal miners these days, but gas suppliers for the smelters of the steel, they're going to lose business as well, okay, because the steel bought overseas is sending money over there. There's less steel being bought here, production declines, and so the various parts or the various materials and services that are needed to produce steel here will also decline. Okay. Now, are there any winners domestically? Well, yes, there are. So people who are involved in shipping and moving goods, longshoremen, railroads, shipping companies, if they're domestically owned, they all benefit from people buying steel overseas and bringing it to the United States, right? So so where do the tariffs come in then? Well, the steel industry might lobby politicians to say this is unfair. They're they call it dumping steel on the United States. Now, dumping really means they're selling it for less than it costs for them to produce it. And it's oftentimes difficult to know whether another country is really dumping or not. It's a blurry picture at best. Okay. But what they'll say is they're dumping foreign steel on the US market, putting US steel producers out of business, costing US jobs. Therefore, put a tariff on foreign steel so that it makes it as expensive to buy foreign steel as it does domestic steel. Okay, so let's say, again, on that 1,000 tons of steel coming from China, they put let's say they put 100% tariff on it. Okay, so now the steel costs $500,000. There's a $500,000 tariff for $1 million, plus you still have to transport it another $100,000. So now that 1,000 tons of foreign steel costs $1.1 million. Do you see that now it's cheaper to buy the domestic steel? Okay, here's the thing. Now the domestic steel workers are protected and their suppliers are protected, but what happens to all the people involved in trade and transportation? The longshoremen, the railroads, the shipping companies, they lose that business. Okay, so it hurts them. Who does it also hurt? It also hurts consumers, because now consumers are going to have to pay a higher price for their cars, because the car company is going to pay $1 million for 1,000 tons of steel instead of $600,000. That is added to the price of the car. So people say, well, it's the companies that pay the tariffs. Well, yes, that's true. But just like with excise taxes, the companies are really just a pass-through entity. They add the cost of the tariffs to the price of the goods that they sell. So we as consumers pay it. The companies collect the money and they send the money to, in this case, the federal government. That I forget the name of the agency that collects tariffs, but the companies themselves, they're not actually paying for the tariffs. It's like the corporate income tax. The corporations don't actually pay it. It's an additional cost of producing whatever they're producing or providing whatever services they provide. We, the consumers, actually pay for it in higher prices. So the thing with tariffs is that they raise the price for everyone consuming that good, in this case, cars, while while they do protect the steel industry, they hurt the transportation and trade industries, and they also hurt the auto industry in the sense that as the price of a car goes higher, but the higher price is going to taxes. That money is not available for, among other things, higher wages. Again, just like the corporate income tax. More of the price of the car is going for taxes, and so it's not available to pay higher wages. So auto workers, and in fact, people investing in the automobile industry as well, generally speaking, also lose out. So why do countries impose tariffs? Well, like I said, one reason they do it is to protect certain domestic industries. Okay, now, is that a good idea? It depends. Okay, so part of the tariff debate going on here in the United States is a lot of our military technology comes from not the technology itself, but the actual devices. Components of them are made in China. Now, China is one of the United States' biggest geopolitical rivals. Okay, so do we want to have those things made in China? What would happen if we got into, God forbid, really God forbid, a war with China? Are they going to keep sending us that military hardware? The answer is probably no. So what are we going to do? Well, one thing is we might put tariffs on those items, making them so expensive to buy from China that it makes more sense to produce them here because of national security reasons. Okay, so in that case, although the tariffs are imposing a cost on our economy, okay, we decide to bear that cost for national security reasons, because we don't want a geopolitical rival having power over whether we can properly supply our military. Okay, that's one reason for imposing tariffs. Another reason for imposing tariffs, or usually these are called sanctions, although they're somewhat related, is to punish an adversary for their behavior. Okay. Aside from that, and I told you I would tell you my position. So in general, I believe in free trade. Overall, it's better for everybody, not for everybody, for the largest number of people, because free trade lowers the cost of goods most broadly. It does have a tendency to affect some industries and not others. Okay, but the reality is, for a country to have high tariffs, what ends up happening is, if we impose high tariffs on one country, generally speaking, that country imposes tariffs back. So if we were to impose high tariffs on everything coming from China, almost inevitably China would impose high tariffs on goods being exported from the U.S. to China. And those would be a lot of agricultural goods. For example, a lot of pork. China eats a lot of pork. A lot of it, they had a big problem with I forget what the name of the disease was, but their pig supply was way down, and so they were importing pork from the United States. So if we impose high tariffs on Chinese goods, one of the China reacts and imposes tariffs on American goods. One of the losers typically will be people involved in agriculture. So you might say, well, but agriculture is a big business, Archer Daniel Midlands and all, they can afford it. Again, they're not really the ones paying for it. It's we as consumers who end up paying for it. And what happens is if the demand for pork in the United States goes down, either because of the domestic demand goes down or the demand for exports goes down, the people who actually grow the pigs, which are a lot of small farms, they end up losing out, right? And they may lose their farms. The same thing is true of grain, all of those kind of agricultural products. So, and in the end, everybody ends up paying more for agricultural goods, whether it's meats, grains, whatever. Okay, so the reason I bring this up is so that as people, politicians, whatever, talk about these proposals, we can understand how they will affect people. Now, I gave you my opinion just because I told you I would. Other people are, they have a different opinion than I do. I would encourage you to talk to friends, hopefully friends who are knowledgeable about how these things work. Tariffs are not a free lunch, okay? Imposing tariffs on another country, it's not free to us. They inevitably cost us money and jobs. Now, there may be a good reason for accepting those hits to our economy, like national defense, but they may not be good reasons. And so people, in our country are experiencing a lower standard of living and or losing their businesses for not a particularly good reason. So I encourage you to think about these things, the impact of taxes on you, on the economy at large. So today I talked about, again, capital gains taxes. I said I was going to talk about estate taxes. I didn't have time. Maybe I'll do it another time, or you can tune into my Monday show to find out about that. But today I talked about capital gains taxes, excise taxes, and tariffs. All of these taxes not affect us as consumers, but they also affect how our economy works in terms of where investments are made, how successful those investments may be, and therefore whether our economy grows, whether we add jobs, all of those factors get mixed in. So I thank you very much for joining me today. Really appreciate it. Tomorrow, this is the Every Other Week show at 5 p.m. Thursday, is my show Jiggers' Place. It's a time for us to have a cocktail, relax as we head toward the end of the week, and talk about everything not related to business and professions. So tomorrow, I'm going to be talking about a fabulous book that my daughter introduced me to. It's called Flowers for Algernon, a classic book from the early 1960s. You may have heard of it. You may have seen the movie that was made from the book. I had heard of it, never read it. And my daughter said, Daddy, you really need to read this book. And so I got it. And because, my daughter wanted me to, the kind of dad I am, I guess, I read it. I couldn't put it down. It's just an absolutely amazing book. So we'll talk about that tomorrow over a cocktail. If you want to get the cocktail recipes in advance, please go to my website, scroll down to the bottom of the homepage, and sign up for my email list. And the emails I send one email before each show. That's all the emails, generally speaking, that you're going to get. And the email I send out for Jiggers' Place always has the cocktail recipe. So if you want to make it along with me, or if you're a good mixologist yourself and you just want the recipe, you'll have it there. And you'll also get notified a couple of hours before each one of my shows goes live. So I thank you for that. And talking about subscribing, if you haven't subscribed to my YouTube channel, please do consider that. Just, go to youtube.com/@thewaytowwow. Click on the subscriber button. And again, you'll always know when a new show goes live or posts on my channel. I would really appreciate your subscription, working, of course, to grow my channel. So again, thank you very, very much for joining me today. Would love to hear your comments. All the social media links will be in the show notes after the show posts on YouTube. Feel free to make your comments. Always interested to hear what you have to say, good, bad, or indifferent. And hope to see you tomorrow, 5 p.m. Pacific time at Jiggers's place. And signing off as I always do, Marie, darling, you are my bell. Courage at all times.